Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News, or should I say the second edition of this week's MFB News. I actually recorded the first two segments to MFB News this morning at 6:30, but owing to some news that's come out about inflation and the impact that's had on the mortgage market, I've now had to re-record the videos. This is my second attempt. So for those eagle-eyed amongst you, you may notice there's a bit of disjointedness across the kind of video this week. I'm so sorry for that, but literally it's because we wanted to make sure that the news we brought to you was fully up to date and things have moved on apace. So hence the reason we've had to re-record some of this, and it may seem a little bit kind of out of place. So apologies for that, but I'm sure you understand why. Now, I hope you're all keeping very, very well and everything has been good. I am starting to wonder who on earth has switched off spring. I woke up this morning to rain pounding off the window, so more than ready for the weather to cheer itself up, and I'm sure I'm not alone in that. This week, we're going to be, well, we were going to talk about swap rates. We are going to talk about swap rates, but with the latest inflation news that came out this morning, things have really done a bit of a U-turn in terms of what I was saying to you at 6:30 and what I'm saying to you now. So we're going to talk all about what's been going on with the inflation news and what this means for interest rates, and also bank base rate, the meeting that's happening this week and the likely outcome of that as well. So things are literally changing on a dime right now. We're also going to do our usual update on lender pricing, and then we're going to round off with the latest house price news out from Rightmove as well. So lots to cover off this week. Okay, now before I go any further with this, I just wanted to share with you the fact that we are holding a webinar on the 29th of March. I'm going to be running it, so I'm going to be your speaker, and it's going to be really, really good actually. So we're going to be covering off not just mortgage information in terms of what's going on. For those of you who watch this video frequently, you're very, very aware of what's going on, but we're also going to be talking about things like investment opportunities, different types of yield depending on the type of property you buy, so how to really capitalise on return if you're making a new investment. Also talking about property hotspots, so which areas in the country are yielding the best. So lots of great information for those of you who are thinking about investing as well. We're also going to be talking about refurbs. Refurbs are really having a moment with landlords at the moment in terms of them looking to acquire property and add value, so how to finance those as well. So lots of great stuff. So if you are interested in joining us, it's a virtual webinar. It's going to be held on the 29th of March, and if you go to the comment section below this video in YouTube, there's a link to sign up and register for it there, or if you subscribe to our weekly investor update newsletter, there's also going to be a link available on that for you as well. Okay, so let's move on to the mortgage market and what's been happening. Who knew swap rates were such an exciting thing? So this morning when I recorded the video, what I was saying is that swap rates have come down to 3.5-ish%. And the reason they had come down is because it was looking increasingly likely that the Bank of England would not need to increase base rate further because of the news that the Fed would not be able to continue to increase its interest rates in the States because of the fragility of the banking sector over there at the moment. This is kind of in reference to particularly Silicon Valley Bank and what happened there just over a week ago. Fast forward to this morning, so literally I recorded the video, switched off my camera, a BBC news alert came through on my phone saying that there's new inflation figures out and actually things aren't quite what people were expecting. So the market had been feeling quite confident about base rate, inflation was coming down, the Fed was unlikely to keep on pushing up interest rates, and so the money markets had really calmed themselves and swap rates had eased down to 3.5% and were kind of sitting around that mark for the last few days. However, the latest inflation news has just come out and there has been an unexpected rise in inflation to 2.4%. The general consensus was that we were expecting it to be at around 9.9%. It was at 10.1 in January, we were expecting it to be 9.9% this month. Actually, it's come out at 10.4%, which is higher than people were expecting. There's a whole load of information about what's been going on here that you are very, very easily going to be able to Google and find out about. But the key point here is that actually now the Bank of England, who are meeting at 6 o'clock this evening to have their discussion about what they're going to do with interest rates, which then gets announced tomorrow, are going to have a bit of a conundrum, because actually it shows that we have not necessarily really got over the worst of inflation. Actually, it's maybe not as under control as we hoped. And this is something that actually came out a couple of weeks ago in the US and the Eurozone as well. So unfortunately it feels quite familiar, this. So this means that what has happened is that now people are saying, well, actually, whereas before the expectation was that base rate would not be going up in March or it may be going up by just 0.25%. Previously, everyone was saying it was a half. Actually, there's a much stronger likelihood that the MPC will be forced to increase base rate in March by up to 0.5%. So there's lots and lots of factors at play here, as you can tell. I think really the important thing for you as borrowers, so how does this actually impact you? So look, if base rate goes up by 0.25% or 0.5%, this is really going to impact those people who are on variable rate mortgages. They tend to be either directly linked or indirectly linked to base rates. So a movement there normally means that a variable rate mortgage will move up or conversely down if that's the way things are going. So obviously these guys are really hoping that base rate stays where it is for the time being. However, like I say, that's looking increasingly unlikely, unfortunately. Now, for those people who are on fixed rate mortgages at the moment, an increase in base rate doesn't make much difference to you right now, so you don't need to worry too much. But for those people who are thinking about taking a new mortgage, a fixed rate mortgage, how does this change in swap rates impact you? So this is where it gets quite interesting. So we had seen swap rates sitting at around 3.5, 3.6% a few weeks ago, and then they started bubbling up. For those of you who watch this video frequently, you'll be very well versed in us talking about this. So they'd moved up to around 4.1%. What was interesting then is that actually, while there were definitely a handful of lenders who increased their fixed rate pricing during that period of time, there was also a lot of lenders who did not. So a lot of lenders were saying, actually, we can afford to sit tight for now. Let's not keep on moving things around. You know, it's very time consuming and expensive and disconcerting for borrowers. Let's just leave pricing where it is while we can and see what happens. So these guys actually didn't put their rates up. So when swap rates came back down to the 3.5, 3.6 level, I think there was probably a real contingent of lenders who were thinking, this is good, we're back down to where we were previously, nothing more to be done at the moment, and maybe we might reduce rates a little bit going forwards. Now, in response to the news about the inflation figures this morning, I'm just going to double check where the numbers are live as I speak. So 5-year swaps have gone up to 3.733, same time yesterday they were at 3.519, so they've increased by over 0.2%. So I think this really does just illustrate how things are literally moving around all the time just now. But obviously with an increase in pricing, this would mean that actually lenders will be less likely and in some circumstances unable to bring their rates down. So for those people who are waiting for fixed rates to ease off, it's going to be a further delay. How long a delay is going to be? I mean, it could be a few days and this could be months. It really is impossible to tell at the moment. But I think the key message is that actually if you see a 5-year fixed rate or a 2-year fixed rate that you'd like, apply for it, book it now, because there is so much uncertainty in the market. The very good news actually, and not many people know this, is that if you apply for a mortgage rate now and the lender subsequently before completion drops their fixed rates, they generally do let you move on to the lower fixed rate as long as you haven't drawn down on the mortgage. Now, some might charge you a small administration fee. For those that do charge, worst case, it's like £300, but most lenders either do it for free or maybe 150. But what it really means is that you can apply for a rate now, you can book something in, because at the moment it's just impossible to really understand how things are going to shake out. But actually between now and completion, if the lender does drop their interest rates, you can move on to the lower deal. So it really is a bit like having your cake and eating it. Okay, now moving away from the money markets and base rate and moving on to lenders and what they've been up to in the last week. So there has been quite a lot of movement. We've seen Accord Mortgages make reductions to their pricing of up to 0.29%. So their 2-year rates are now starting from 4.8, 5-year fixes from a lovely 4.55, definitely worth considering. Now with Accord, these are a vanilla lender, so no limited companies, no HMOs, no multi-units. With these guys, they don't need you to have a minimum income or an arbitrary level of income, but they do need you to have an income that's not from rental. They can accept applications up to your 75th birthday. The mortgage needs to be paid back by the time you hit 85. And you can have 10 mortgaged properties in the background, no limit to the number of unmortgaged properties that you have. We've also seen Accord change their criteria for their rental calculation on your background portfolio. So when you apply for a buy-to-let mortgage, the lenders will not only assess the rental income on the property which they're mortgaging, but they will look at the rental income and the servicing across the background portfolio as well. So what they'll do is they'll apply a calculation saying, you know, in terms of the background debt, the rent needs to be, you know, 145%, assuming interest rate of 5.5% or whatever it is on the background portfolio. And there is a lot of variations, as always, in terms of the actual calculation that they're using, but they do all run these calculations because it's an PRA requirement for them to do so. Now, what Accord have done is increase this calculation. So they would have been saying previously that the rent needs to be 145%, assuming an interest rate of 5.5%. They've now increased that to 5.5%, so by 1 percentage point. Where does that leave them in terms of the market? You know, it just sort of makes them be aligned with everybody else. I don't see it as a massive disaster. I think what they've just done is lose a little bit of the kind of edge that they may have had over some of their competitors. I've also seen the leads reduce their portfolio product rates. The portfolio product is for those landlords who are classed as a portfolio landlord, so those with 4 or more mortgage buy-to-let properties in the background. So the leads offering here, 5-year rates are now from 4.82 and 2 years from 5.05. Now again, the leads very similar to Accord, no multi-units. They can do some very kind of gentle HMOs, so very small HMOs, but they can be licensed. Different set of pricing for those, but key points here: 10 buy-to-lets in the background, no minimum income requirement, but must have income that's not from rental. And one of the lovely things about the leads is they don't have a maximum age. You can apply for a mortgage at age 75 and it can run for 35 years. I don't know how many of us are planning on staying landlords until we hit 100. I'm never glad to hit 100 at all, but I'm not sure I fancy running a portfolio by that age. But if that's your thing, the leads could be the answer for you. Now, Coventry are making some adjustments to their pricing downwards for portfolio landlords again. They've not yet announced the new rates, but what they have announced is that they have reduced their rental calculation on the 5-year fixed rates. So if you're applying for a 5-year fixed rate mortgage with a Coventry, the rental calculation they're now using means you can borrow more per pound of rental income than you could do previously. The calculation that they're now using is 125 or 145% coverage, assuming an interest rate of 5.5%. Previously it was up, I think it was 6.79 or something like that, so it's come down really significantly. Skipton have reduced their 5-year fixed rates. So their 2-year rates are now starting from 4.82% and their 5 years are now from 4.6. Again, Skipton, in terms of their criteria, you know, just think about Accord Mortgages, Leads, those guys, all very, very similar in terms of maximum number of properties in the background, income requirements, so on and so forth. Now, moving on to the more specialist end of the market. So we've seen West One introduce some new products, which I am actually quite excited about. So they've introduced a 5-year fixed rate, but it has a 3-year early repayment charge period. Now, the reason I really like this is when we're speaking to clients, a lot of people are saying, you know what, I don't really want to take a 5-year fixed rate because I think over 5 years, and I suspect they'll probably be right, rates will have come down during that period of time. To tie myself into a 5-year fixed was very expensive. However, when we then go to run the numbers on the rental calculation, because you can borrow more per pound of rental income on a 5-year fix than a 2 or 3-year fix, the numbers aren't working. So people are almost being forced to take 5-year fixed rates when they don't want to. So this offering by West One is actually really good because you have the benefit of the 5-year fixed rate and therefore the rental calculation, but you're only committed for 3 years. So it really is a bit like having your cake and eating it, really, which obviously we all like to do. Now, in terms of the actual interest rates they're charging, they're not super good. They're from 4.99 for their standard range, so individuals and limited companies, and 5.19 for specialists, which is your HMOs and multi-units. They're not terrible rates by any means, but they're just not absolutely standout either. But actually, for me, the fact that they bring with them this shorter ERC period could be very, very good for people, because you may take the view that, yeah, I might pay a slightly higher interest rate for now, but actually, because I can get out of them in 3 years onto a lower interest rate, that's going to work out better for me. So very, very good from West One, so well done to those guys. Now, we've seen MT Finance also make reductions to their rates. The last 2 weeks, their rates have gone up. Now they've gone down again. Their 2-year fixed rates are now from 4.95, 5-year fixes from 5.57. Please watch the arrangement fees, though. They are quite mighty on their lower product rates, and this is the same for many lenders now. So lenders are bringing out a real swathe of lower interest rate products, but with higher arrangement fees. They will always have in their product set a higher interest rate with a lower fee version as well. So there's something in there for everybody. Now, Kensington Mortgages have made reductions to their limited edition rates. So their 2-year fixed rates from 4.79 and 5 years from 4.99 on standard properties, and very similar actually pricing on HMOs and multi-units as well. Kensington are a specialist lender. So again, they're things we would expect from them. So they do individuals and limited companies, no maximum number of properties in the background, no minimum income requirement, that kind of stuff. And keeping on that vein, we've also seen Keystone bring out some new lower rates as well. So their 2-year fixes are from 4.69 and 5 years from 5.09. Again, watch the arrangement fees there. Now, Keystone are a brilliant lender. They very much work on the basis of people underwriting mortgages rather than computers. So they have a whole room full of very, very experienced underwriters, and really their approach is very much to get the deal done rather than to put things, barriers in the way. So we were able to have some really good conversations, and actually over the years we've been able to get some pretty incredible deals across the line with them. Now, in terms of kind of headline rules around their criteria, so no maximum number of properties in the background, no minimum income requirement, they can do SPVs, they can do trading companies, they can do layered companies, they can do day one remortgages. Their appetite for HMOs and multi-units is very strong, and they can do slightly larger blocks than most of their counterparts as well. Now, lastly, just to wrap up, because I know I'm going on a bit here because it's been another busy week, Fleet have made reductions to their 2- and 5-year fixed rates by 20 basis points. And Paragon, in the middle of last week, withdrew some of their limited edition rates. Thankfully, we were very lucky we were able to hold on to them, but most brokerages, and if you were to approach them directly, they would have disappeared. But they've now brought up some new ones as well. So their 2-year fixed rates are back from 4.8 and their 5 years are from 4.9. So an uber busy week from the lenders this week, and I suspect next week will look not much different. Okay, now lastly, I'm just going to touch on the latest data that's been released by Rightmove. So what they're saying is that the average asking price of a property coming to market in March has lifted by 0.8% to £365,367. And what they're saying is this is pointing to a stable start to the spring buying season. Now, they go on to add that asking prices are below the average rise in March of 1% compared to the month before over the last 20 years, which is reflecting caution among new sellers. However, it adds that the exception to this caution is a 1.2% monthly jump in larger top-of-the-ladder homes, in contrast to a more modest 0.4% and 0.5% rise in first-time buyer and second-step properties, respectively. So what they're saying here is essentially those real sort of large properties are up 1.2%, whereas the smaller properties are up 0.4 to 0.5, because that blended across them, the average asking price is up by 0.8%. Now, it's interesting to go on to say that it points out that new seller asking prices are now £5,800 below last October's peak as the market cautiously moves towards pre-pandemic activity levels despite the economic turbulence. The data continues to point to a market on a much more stable footing than many anticipated and cautiously transitioning towards the activity levels of the more normal market of 2019. Now, this is the bit that I found really interesting. So the Rightmove Director of Property Services, Tim Bannister, has been quoted saying that the beginning of the spring season sees stability and confidence continuing to return to the market as it recovers from the turbulence at the end of 2022. The pace of the market reached an unsustainable level in the last 2 years and was on track to slow to a more normal level, although the speed of this slowdown to a more normality was accelerated by the reaction to September's mini-budget. So I think reading between the lines here, what they're actually saying at Rightmove is that the activity that we're seeing now is actually just quite a normal level of activity. So it's not that the market is desperately bad or things are really awful. Actually, things are just behaving as they normally do. It's just that if you compare it year on year, and in the sort of particularly in the property market, we love to do year on year comparisons. Last year was not a normal year, so actually anything's going to look rubbish compared to that. But if you take things back to pre-pandemic levels, which is kind of our last real normal level of activity, we're kind of there or thereabouts. So I think in terms of what this means for house price, it looks like actually things are potentially going to be really robust, and actually we've seen kind of the last of the fall in prices for now at least. Actually, before I go, I did just want to say one more thing about those who are interested in tracking what is turning out to be the most underwhelming experience I've ever had in my life of me getting back my buy-to-let property from my non-paying tenant. So the latest on that is that the Section 21 period has kind of ended, so my notice period has ended. Obviously, the tenants haven't moved out. So the papers have now gone to court, and we just wait. We just wait until a date comes up in the court for them to look at my papers. Now, actually, one thing I learned the other day, did I learn this from my solicitor? No. Did I learn this from a client? Absolutely. Because it turns out solicitors don't really like to tell you what's going on. You're just expected to just trust them with everything and not know what's happening, but just believe that they're just dealing with it, which I find really, really difficult because I want to understand. But one of my clients told me that when you issue a Section 21, there isn't actually a court hearing. It's just the judge picking up the paperwork, making sure that everything's kind of ticked off properly, which I guess is why it's so important to make sure that your paperwork is absolutely on point. But assuming that you've kind of gone through everything and done everything right, then they literally just kind of sign things off. So I'm just waiting for a judge to pick up my file now. I do believe that the timings are such that that can take anything from between 4 weeks to 3 months. So we're just sitting on our hands. The Section 8 situation, so my tenant was in breathing space, which meant that we were unable to pursue the Section 8 option of this until now. So I'm going to be chasing up my solicitor to see if they've actually done anything with that, as the breathing space ended a few days ago. I suspect not. I'm finding, yeah, the whole thing just really frustrating and slow. I think the only person who really seems to really want to get this sorted out is me, is the sense that I get. I don't know if I'm alone in that, and you guys have had something similar. But like I say, I think my overarching feeling about this whole experience is that I'm just entirely underwhelmed by the whole thing. Okay, so I'll stop whinging now, and I'm going to leave you to it. So thank you as always for joining us. If you have any questions, you know we'd love to hear from you. 0345 345 6788, or have a look at our website where you will find absolutely loads of information. Do sign up for the webinar, and I will catch you guys again at the same time next week. Look after yourself until then.